Hello guys and welcome back to another video on this channel. Today I'm going to be going through the 3 golden time frames that I use week in week out on the Forex markets. If you didn't already know, there are many different time frames that are used by traders across the world within the Forex industry. The time frames are used to show a time representative of each candle printed. For example, we have the daily time frame. Each candle shown on this time frame represents price action for a whole day. And we have the lower wick of the candle, which shows the lowest point price reached at some point within the day. And then the upper wick represents the highest point, which price action reached at some point throughout the day. Then between the two wicks, we have what we call our candle body. And this shows where price has actually closed on the given day and from where it opened to where it closed. Now, if we were to hop onto a 4-hour chart, each candle would represent the price action within a given 4-hour time period. We know that we have 24 hours in a day, so the 4-hour time frame shows 6 candles to represent a daily candle. So in other words, every 4-hour candle used represents 4 hours worth of price action. 6 of these combined together at the right time are the makeup of the daily candle. So knowing this, you can use other time frames in the same way. So for example, we also have the hourly chart, which some traders use. Each candle represents price action of every individual hour of the day. So if we also have the 4-hour chart, we know that a 4-hour candle is built up of 4 individual 1-hour candles, and therefore for our daily candle, which is built up of 24 hours, there is 24 1-hour candles built into this. Now we understand how the timeframes work in terms of price action representation, but there is clearly many different ones as we drop into timeframes consisting of different minute intervals. Because of this, there are many different options to use. So how do we know the best ones to use? Well, industry-wide, there is no given golden timeframes. Each trader is different in their own right and therefore have their own variation of different golden timeframes. However, for the technique that I use and have used for years, there are 3 main golden timeframes, and I consider these to be the best timeframes that are out there. Obviously, this is just my opinion. So firstly, we have the daily time frame. Personally, I like to check this at least once a week. Sometimes, if price action isn't the greatest, I also look for a second or maybe third time in the week. But the reason I don't check this so much is because on a day-to-day basis, you have to wait the whole day for the candle to close. The fluctuation is over a much longer period of time. Therefore, there is no reason to constantly check it. If you think about it, changing a swing bias could take potentially weeks because you have to build up so many different daily candles. So the daily time frame is used as a rough guide. Having said that though, high time frame POIs are obviously stronger than lower time frame POIs. So if you're within a daily POI and there's the 4-hour, say for example, which is a lower time frame, shows conflicting bias, then usually you would go with a higher time frame. The higher time frame takes precedent because there's a lot more price action stored in this data, and therefore it gives a stronger confluence. This leads me on to my second time frame, which is the 4-hour. This is my personal favorite time frame for referencing data. It is a powerful time frame and can show decent movement from day-to-day trading. Can also show plenty of price action and strong structure. Because of this, it is an important time frame to use for a point of reference. What do I mean by this? Well, if I'm executing a position within the markets, I want to make sure it is in line with the 4-hour bias 90% of the time, because high time frame, as previously mentioned, takes precedent over lower time frames. So if we are looking for buys and our 4-hour bias is also suggesting the same, it can be used as a strong confluence to back up our approach in the markets to go and execute a long position in the market. Finally, the 15-minute time frame. This is the time frame I use to execute a trade in the markets. I use this because it is a lower time frame than the 4-hour, so it allows us to catch larger moves in the markets with a better stop loss and a finer refinement to catch them sniper entries. If you haven't watched my previous video on sniper entries, I suggest you do so. This explains more in depth how sniper entries are achieved and their importance. Anyway, back to the 15-minute time frame. If we have a 15-minute trend direction which matches our 4-hour trend direction, then this should alert to you that longs are pro-trend and are the highest probability trade. The 15-minute time frame also naturally provides us with more opportunities than others high time frames, such as the 4-hour and the daily. This is because the amount of 15-minute candles that goes into a 4-hour candle is 16. Therefore, we have a greater chance of judging the variation of price action and allows you to capture moves when a bias is deemed to change direction. This way we can play high time frame pullbacks and also pro-trend moves. So within the stocks and shares markets, which I've touched upon before, you can only buy into the markets. Being able to use the lower time frames of the Forex markets means you can go both long and short. So why just these 3 time frames? What happens if I use more? There is of course a reason why I stick to these timeframes. I haven't just randomly plucked these out of thin air. I've done plenty of backtesting of using just these 3 timeframes over the years, and it works well for me. But the same question can remain. If higher timeframes are used with lower timeframes to build confluence, then surely the more timeframes used in conjunction with one another stacks for a stronger confluence. In theory, this would seem plausible, but in reality, using too many timeframes actually just confuses things. Each time frame obviously shows market structure differently, and it also shows the variation of price action different to one another, ultimately resulting in a different insight into the refinements of the markets throughout the day. This is done on so many different levels throughout different time frames that biases can actually conflict with one another. So for example, the 4 hour and the 15-minute might match up, but the 1 hour might not. And so if you're looking to execute on the 15-minute, which is in line with the 4 hour, but then the 1 hour is telling you a different bias, then this just confuses things, and you can't truly understand which bias to stick with and which one not to. So I hope this video helped and you enjoyed it. If you did, be sure to like and subscribe for future videos. Still many more to come. And until next time.